Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with my good friend Doug Heagren. Hey, Doug.
Hey, Kirk, it's been a while. It's good to see you again. I think we've had some other people usurp me lately, as I've had a lot of conflicts. So it's good to be back.
Oh, Doug, they can't usurp you. You're not in the same league.
Absolutely, that's true. They were already much higher, much better to begin with.
Take that how you want. You're not in the
Yeah.
same league. Or worse. All right. Well, let's dive in. So Doug's been on enjoying himself for the last few weeks. We had Phil, thankfully, covering for him, but now we're back to the Kirk and Doug show. So we're gonna dive right in. We've had a lot of stuff to cover. I know last week we went over a bunch of interesting stats, but want to touch on a few different areas today. But before we begin, I did want to kind of go back because I've gotten a bunch of emails about this on the perspective of the markets and how it interplays with reality. And I've been talking about it for the last few weeks, so I'm just going to touch on it, and then we can get into some of the real life stuff that's going on, which is that frequently when people look at the market, they look at the markets as if they are today. They say, all right, the market is pricing in ABC stock at $100, then that's assuming that it deserves to be at $100. But the reality is that it doesn't. The reality is that all of the market information everyone's got out there for the next 6 months has put the market at $100, and it's assuming that 6 months from now, all else being equal, it's going to be at $100. But then 6 months from now, they're not looking at that date. They're looking at 6 months from then. So the market is always looking 6 months forward. And of course, we can never tell the future. So that's why we have volatility. The market prices in 100 based on the known information. And let's say ABC stock comes out with some earnings that are less than expected. Then the stock's going to go down because people are going to look at their models and say, all right, well, based on this new information, it's not worth 100, it's worth 98. So then the stock goes down 98 expectations 6 months from now. So when you see this big volatility, like really big volatility that's isolated to that stock, I'm not talking about the market dropping and everything else drops. I'm talking about a very specific earnings comes out, the stock drops or goes up. That is based on the market readjusting to a very unexpected number. So if you start to see big moves, it's because the market was not expecting that. It's not because the recent news is crazy good or bad. It's because based on the market expectations, things are mispriced. So when you see a stock that's getting beaten up and and the earnings come out and they're horrendous and the stock doesn't go down, if anything goes up, it means all the bad news is out. That's what that means. And when the stock's at all-time highs and it comes out with blowout numbers and the stock just kind of stays where it is, that means that expectations were already built in and it hit expectations. Now they have things called whisper numbers, which are basically the expected numbers that people have for economic indicators, for earnings, all of it. And all that's great. But at the end of the day, what really matters is what the market thinks. So in some ways, it doesn't make sense to try to get insider information on what's going on. I know that's always been a thing. Oh, let's get insider information. And of course, that's illegal, and we don't advise it. But people are always trying to get an edge because they want to get that edge of information that nobody else knows. The problem is there are way too many people out there who know way more than us. So if you ever hear someone give you a tip, and I'm doing that in air quotes for all you audio viewers, if anyone ever gives you a tip that's not known in the market, ignore it, because the reality is that 99% of the time it's not a tip. It's everyone else has already known that and discounted it, and it's in the price, or it's bunk. One of the two. But if you ever get a bunch of tips that don't pan out, it's because it's not really a tip. Now, if the CEO, if you know something about the CEO that hasn't come out and, like I think there was a thing in Hewlett Packard, I think it was maybe like 10, 15 years ago, the CEO, and I don't want to mischaracterize, but the CEO was, let's say, diddling somebody. It was maybe a stewardess, an airline, or there was some improprieties going on. I don't want to mischaracterize, but there was some improprieties going on. It had nothing to do with the company, it had nothing to do with the earnings, nothing. And the stock dropped, I think it was like 10% over it. Now, was that a good reason to drop the stock? Probably not, because, I mean, personal life aside, that doesn't really impact the company. So why did it drop 10%? I don't know, but I thought it was a great opportunity to take advantage of a mispricing, because the market drastically mispriced the stock. Whether you liked the stock at the time or not, at that moment, it didn't really matter. What mattered is the market overreacted. Another example is in December of last year. Everyone thought we'd have like 7 rate cuts, or 9. I think Bank of America, if I'm not mistaken, said 9 rate cuts. Everyone was going crazy on how many rate cuts, and we said 0 to 1 rate cuts this year, maybe even a rate hike, but probably stay the same, or maybe 1 cut would be it. That was our expectations for the year. And what has everyone done in the last few months? Oh, well, they're kind of more in line with our thinking at the moment, which is really interesting. Now, you could say I was wicked smart, as they say in Boston. I would say I was just not caught up in the media. To me, it seemed pretty obvious that there's no reason for them to drop rates. The market wants them to drop rates because they want the stocks to go up forever. And that's not always the case. I look at it and say, well, why should they drop rates? The market's doing fine. There's no recession. The markets don't seem to be selling off. Yes, inflation's picking up a little bit. All that leads to interest rates staying the same, or maybe even going up. And everyone's saying dropping, but they weren't. I don't know if they really believed it, or they're so bought into the Fed put that they've had for 2 decades now, Doug? It's like 2 decades. They've had the Fed put, which basically means if the market goes sour, they're going to lower rates and they're going to print money. That's been going on so long, I think people are just addicted to it, and they don't realize that that's actually not normal market behavior. And now it's actually acting a little bit more normal, although the market's going up, it's a bit abnormal, and we're going to talk about that a little bit today. But it is interesting that high interest rates still leads to a higher stock market. Like I said, we'll get into that a little later. But it's still discounting. So you should say, hey, this is interesting. Rates are not going down, or at least the market doesn't perceive them as going down. Or maybe they do and they just don't care. But either way, the market doesn't seem to care about rates not dropping as much as they thought. December, it was like, oh, markets are going up. They're going to drop rates 7, 8, 9 times. Now they're talking maybe like 2 to 3. I would say probably 0 to 1, but they're saying 2 to 3. And the market's still not dropping. Isn't that interesting? So either the market doesn't believe it. I know it wasn't discounted before, because people were definitely not discounting that, at least from what I saw. So basically, I think the market just doesn't believe it. I think the market thinks, yeah, the Fed, you're gonna blink when it comes down to it. I don't think they're trusting the Fed at this point, which is in a way a problem. But at the end of the day, it needs to lead to market pricing and behavior. This is a public service announcement. Have you ever played the lottery? My state advertises that you can't win if you don't play. What they don't tell you is that the lottery is a tax on people who are bad at math. How many lottery winners have you met? Probably none. If you don't like your chances of winning the state lottery, you're definitely not going to like the chances of winning the inflationary lottery. The inflationary lottery? That's right. Your chances to win the state lottery might be 1 million to 1. But you're guaranteed to win the inflation lottery because it affects everyone. And the prizes stink. But here's what you're going to win: higher prices at the store, shrinkflation in your packaged goods, higher heating prices to heat your home. Who doesn't want to win that lottery? Much like the government, I feel bad that your costs are rising. So I want to help you out by giving you some free money. It's not a lot. It's only 1 million Zim dollars, but it's something. Well, you can't buy anything with it, but it does look good as wallpaper. And if you live in Europe, you might even be able to use it to heat your home this winter. If the lottery is a tax on people who are bad at math, then inflation is a tax on people who are bad at economics. I want my listeners to be better at economics. So I'm giving my loyal listeners free money. Go to www.moneytreepodcast.com/free money. Follow the instructions to get your free money today. I have a large audience and a limited number of these currencies. So let's make sure we get yours before we run out. Go to www www.moneytreepodcast.com/free money. Follow the instructions and get your free money today. So I don't know, Doug. You've been at this a long time. What are your thoughts on all this? How are you seeing the markets in compared to reality?
Pure and utter euphoria. I think that if I was going to use a word that I'm coming up with, and I'm going to take full credit for it, it's called. I'm going to say it's a phrase called irrational exuberance. I'm taking credit for that. I came up with it
Yes,
today.
you made it. You heard it first in the show, folks.
First time on the show. For those of you, if it sounds familiar, what do they say as a disclaimer? Any similarity to likeness is purely coincidence. No, I mean, to me, it's exactly what it is. We've talked for 2 years almost on this, where we had talked about a lot of the issues coming out of COVID, leading to bullwhip effect, leading to stagflation, leading to concerns around following the pattern of the 1970s, leading to decisions by the Fed that would end up being very Volckerish, hopefully, but then as of late, more Burns-ish, concerningly. We've seen this incredible, euphoria to the markets, a lot of FOMO movement that's coming. We still have, I would argue, Kirk, we're still facing a lot of that bullwhip effect, in the fact that there is still a ridiculously high level of monetary flexibility out there. Now, that is not across all facets of the economy and all levels of income base, right? So clearly, we've also seen the data that at the bottom of the spectrum, people are starting to feel an increasing level of pressure. I was talking to a realtor today who said, look, I'm seeing even more uptick. I'm better this year than I was last year. For the whole year, it was a rough year. But we've got people that are coming and making offers on houses where we are offering $50,000 over asking, and we are getting outbid. We're losing it. And he goes, I think the reason we're losing it is that the sellers are no inspection. We're coming in 50,000 over cash offers. So a lot of people are still able, whether they're downsizing their existing home, there's no inventory, or whether or not they just have a tremendous amount of liquidity, are still pumping and injecting easy money into the system that drives things up. Now, on top of that, you take a look at rhetoric. I saw something that came out several weeks ago, very, very much sounded like I was sitting in the back of a taxi cab in 1920 and my name was Joe Kennedy. And it had to do with Bitcoin. And, and again, nothing to say whether Bitcoin's a great investment or not, whether it's store value or not. That's not the point here. The point was, people are starting to hear from their aunts, uncles, cousins, taxi driver, shoe shine. That's what it was. The shoe shine for Joe Kennedy, saying, I want to get into Bitcoin. How do I get into it? Have you heard of Bitcoin? Have you heard of the market? These things, these patterns in the past have had have storylines behind them. And so when you start to see everybody getting caught up in that euphoria, that is, we're starting to see patterns that I'm not saying are going to fully, manifest themselves, but feel now you're starting to hear, for a while there it was the 70s, right? Then it was, we're starting to see, it looks like the 90s, and with tech and, and even with Bitcoin being that it is a technology, it's part of this blockchain, area, and it's been incredibly correlated to, for most of the time, to technology. There's been a little disconnect lately, but now you're starting to hear people say this looks a lot like the Roaring '20s. And that didn't end well, by the way. It was great while it lasted.
So I've heard.
Yeah, so I've heard. So I mean, so right now, what I see it there, and again, we're and things are different. Say this time it's different. And we said this before too. It is different now. People do have more access to the markets than they've ever had. It used to be you had to go through your broker, you paid your commission, they would put the trade in. There'd be the middle, the middleman, basically the market maker. That would nowadays you can get within the. I just saw another firm that's marketing free investing, and ways that you can get in, which nobody ever did. So we are seeing that pound for pound. We're seeing generationally more people are investing than they probably ever had. They're more hands-on in investing than they ever had. And that is going to drive the narrative a little bit, because that means the demand to invest is going to be higher than it likely ever has, because the barriers of entry are down. And so there's going to be some lasting effect to that may be the new normal, right? We've talked about the new normal before. But yet when you start to look at things, and I know you've got some charts on this that can help to back this up. When you start to look at things like the valuation issues, especially momentum and growth. I know you have a chart on this, and things like the S&P 500, expensive relative to past 10 years. Now, some things are definitely not more expensive than others. I was actually surprised, based on that, Kirk, to see that the S&P 500 isn't as expensive as you would think it is in relation to some of the Schiller index and the price to earnings. But there's also several things that are under, very much still cheap relative to 10 years. So when we talk about that euphoria, it is in definite certain sectors that have an extreme amount of euphoria as opposed to others. And we're seeing a definite shifting that's going on here that, at this point in time, I mean, what's the old saying is, the markets will be irrational, longer than you can be solvent. There's different ways that has been published and stated. And this is one of those circumstances that, if you're bearish, you've been blown out of the water. Okay. And it is getting much, much harder for people with any type of technical analysis, in the aspect of looking at relative, relative, cost compared to averages and technical indicators, but definitely fundamentals, and definitely looking at price to earnings and things like that. It's getting harder and harder for them to be patient. That's going to drive more and more money in, because those on the side are definitely going to have an increasing level of fear of missing out. At some point, though, there's going to come a point in which there's little more that could be put in. And ultimately, we are going to find out. Like you said, do they believe the market? By the way, I would disagree that insider trading is illegal. Now, for those of you listening, I'm joking. Just be careful who you hear from. If you hear from a congressman, it's totally fine. But if it's from anybody else, it's absolutely illegal. It just depends on where you get your get your advice. But I say this all in jest, people. Disclaimer. But ultimately, with that, there is going to come a point in which there's going to be a reversal. Like you said, they don't believe the Fed. Okay. So now they've reversed how many times they're going to do it. But for some reason, the markets still think soft landing's coming. Maybe it is. We've gotten out of this and now everything's going to be great. The inflation's back down, pricing. Obviously, people are going for financing at 7%, has not slowed down people that want to buy houses. But does it mean to me that the risk is gone? Absolutely not. But it is. But if you think about the comparisons here, the 90s, the 70s, the 20s, all of those had a point in which it was a significant impact to the negative eventually. How long that's going to last, or if it's going to come, I don't know, but the risk is still there. And therefore, it's going to be hard to sit on the sidelines when it's running like this, but yet it's going to be much more. You're going to have to continue to have caution as you look at where things are right now. But right now, there's no sign of stopping. And I've heard March pullback. I've heard April pullback. So far, we're not seeing it. It is an election year. We know that historically, those are very good years for the markets. So, is there something to be said there? Obviously, history repeats itself a lot of times. Doesn't mean every year of an election is going to be great, but we're certainly starting out in a number of ways very positive. It doesn't look like it's anywhere close to slowing down.
Yeah, so I want to share a few charts here. in because I think it's what's happened in the market is some things have changed, and I think a lot of people haven't realized it. And here's some changes. So this is a chart we came across that really talked about the performance year to date, and this is 2024. And what you might notice is obviously in Nvidia, and this is back. I don't. Oh, the 3/27/24. So that's the date as. So we're about a week old. But if you looked at like basically the bubbles, meaning the size of the company and where they are, so the upper left is best returns, and lower right is worst returns. So if you kind of look at what's interesting is I'm not seeing a x-axis here, so let's just for the sake of it just ignore that. But Nvidia is the best and Tesla is the worst. Tesla's like negative 28. But if you look at like something like Apple and Tesla, which are actually down this year, and you look at all the companies that are up, most companies are up, especially the big ones, the Meta, Netflix, Microsoft, Alphabet, Nvidia, they're all up. And then you've got Apple, Boeing, and Tesla down. And, it's fascinating to me looking at this. And there's some things you can take away from this. One, hey, Apple's down this year. You could say good or bad. They've definitely come out with some bad stuff, and not terrible, but in the context of Apple, it's bad. And then, of
Well,
course,
I want to add this real quick, Kirk. You talk about future projection 6 months, right? So the
right,
question right now in Apple is, what do we think it's going to be in 6 months? There's clearly a more bearish view of what they can create to sustain that value right now.
right. And here's part of, and that's a good thought, Doug. And here's part of the problem. If you look at Apple, they've been putting money into automated driving, and they had their Titan project, I think is what they called it, for automotive driving, and they're really all into that market. And then I think it was last week they came out and said, all right, we're scuttling our plans after, I think somebody said they spent 10 billion on that market, and they just decided we're not doing it. Okay, 10 billion. Okay, that's a lot of money. I could have told you it was a bad idea before you spent 10 billion. Just give that money to me. I would have lit it on fire a lot better than you did. But for whatever reason, they decided to do it, and it didn't work out. Now, what they've decided to do is they've decided that, hey, AI is a great idea. Let's partner up with Google. Let's let Google power our AI on our phones. Huh? What happened like in the last few weeks with Google? Oh yeah, we had a ethnic George Washington, ethnic Vikings. I mean, there's all these different, ethnic Nazis. Like, it was just weird. Like, and that's the AI doing their DEI kind of version, and trying to make things more diverse. It's like, all right, obviously you didn't train it well, but the point being is Apple has decided not to go to their own road with AI. They're going to use Google's. I'm sure Google will eventually figure it out. I mean, let's be honest, they're big enough. They got enough smart people in there. Let's assume they can get their politics under control, and they're not all on one side of the ship. They could probably fix it, but if they don't, then they're not going to fix it, and they're going to wonder why they can't fix it. Which is what I've heard is what's happening, but I don't work there, so I don't know. But if you look at some of the other errors, and I'm mentioning them, not of course we always like to kick a stock when it's down because it's easy, but I'll kind of mention. I mean, they're the largest company in the world, I believe, at the moment. Are Saudi Aramco? I think maybe they're bigger, but largest one or two. Anyway, the largest in the U.S. And they're down. Why? Well, they're down because once you get to a certain size, it's a lot harder to grow. So if the expectation is, and I'm making this up, Apple's going to grow 25% a year, and it doesn't, well, now your stock is going to go down, not because, I mean, maybe it only grows 15%, which is still great. But if people are expecting it to grow 25%, then the price, as we talked about, the price is expecting 6 months from now things to be on an annualized 25% growth path. And let's say it's flat. Let's say you didn't grow this quarter. All right, well, we got to adjust our numbers for 6 months from now, which means the stock is not, maybe it should be down 5% or less, or more. So you have to understand that the price is based on future expectations. So Apple's stumbles with their Titan project. With the, I would say AI is going to take them a while, and I'm not sure. I think if they want to, and by the way, Tim Cook, if you ever need some advice, give me a call. Like I got some great ideas on Apple, just in case you're stumbling for ideas. Um, but in all seriousness, I mean, if you think about it, there's some logical stuff. When you get to be that big, what can you do that's going to move the needle? Coming out with an Apple Pen is not going to move the needle. Coming out with a watch, okay, maybe. We didn't think. I mean, that's like 10% of their sales, I believe. I don't know. My number's a little old. Maybe that's not off. Point is what are you going to come up with that's going to move the needle? The market has to be big enough. It has to be profitable enough, right? Because Apple could get into railways, but that's a bad idea, right? It's a huge market, but it's a low profit margin market, and why would you ever get into that? And I say that in jest, but if you look at the last 40 years, a lot of companies have done that. They've owned their own verticals. They're perfect in where they are, and then they go buy an oil company goes and buys like a McDonald's franchise or something stupid like that, something totally unrelated. A lot of companies have done that over the last 40 years and end up having to split it up and spin all those things off at a later date because they were bad acquisitions. For whatever reason, they thought it was a good idea. Sometimes the idea is, well, we just need to grow our earnings and there's nothing we can do. I mean, in reality, what's Apple going to do? They can keep acquiring, but if the acquisitions aren't big enough, it's not going to move the needle. So, what are the areas they could invest in? They can invest in AI. That would be a reasonable thing for them to invest in. Somebody, I don't know if I didn't see the news in the last few days because I've been busy, but someone said that they're looking to get into robotics. Maybe it's another company, but why the heck would a software company want to get into robotics? It might not have been Apple. I thought it was, but anyway, the point is you have to find. I mean, and I won't pick on. I'll stop kicking Apple while it's down. Look at Microsoft; they were infamous for this. When Ballmer ran the company, there were hedge fund guys that I knew. I would ask them like, why Microsoft is not doing well, and they said, well, we just naturally assume they're going to take $1 billion a year and light it on fire with stupid acquisitions. That was their thesis: is that they're going to make a stupid acquisition, they're going to write it all off because they did something, because they did something stupid and move on. Remember Skype? Yeah, me neither. They made that. They paid a lot of money for that, and where's that now?
We're on the new version of Skype.
Oh yes. It's. And I'm sure they got some IP out of that. But the point being is all of this stuff happens. And if you're trying to invest in individual stocks, you have to be really adept at all of this. You have to understand, like, well, Apple's not necessarily going to keep going up because it's gone up for the last 10 years, right? It could not go up for like another 5 years. It's very possible if their earnings aren't. I mean, think of it this way: they have really expensive phones. That how can you charge more for a phone? Do people's wallets support it? They've done a lot to extend it, doing the monthly plans and all that stuff. So they've done a lot to really continue growth. But they do hit a wall, and I don't know if that wall's now. It could be 10 years from now. I'm not making a statement about Apple. Point is they will at some point hit a wall because they're very large. And when companies get that large, it's hard for them to continue to grow at the same rate they've been growing. So what happens is when companies typically get to a certain size, they start to stagnate. Because if you own 90% of the market, like Microsoft, I believe they own like 90%, Google owns more than 90% of the search functions, right? Let's say you own that. How do you grow? Well, you can't. Like there's a certain limit. You can't just grow 30% a year just because you own the market. Like there are limits to that. There's limits to what people are willing to spend. There's limits to how many people advertise. There are just limits. So how do you grow? You have to acquire, you have to do different things, cross promote, whatever. Anyway, point is, as you're looking at this picture, what you'll notice is that the fact that Apple's down when other things are up, that should be a, isn't that interesting moment. Boeing, I think we all know why that's down. Tesla, I mean, you could argue that, but that's actually a different point, which the trend is changing on EVs. But look at this. How many stocks are up versus down? A lot more are up than down. A lot more. So if you want to see, is the market overvalued? Is it strong? Is it weak? Well, when most of the stocks are up, and there's more metrics we can talk about. But when most stocks are up, you could say, yeah, the market's going to sell off here, but you don't really have a leg to stand on. You could say, well, it's expensive. Yep, it is. And it could stay expensive for 10 years. And as it has, it's been expensive for a long time, and yet it still goes up. So being expensive is not a reason to short a stock. It's not a reason to sell the stock. It's a reason to be cautious. Just because something's expensive doesn't mean you should sell it. Now, if something's expensive, well, there are reasons to sell it, like if you hit a target, but generally, expensive is not a reason to get out. You want to have other reasons for that. And here's another reason you should stay in. We talked about a few weeks ago the listener who complained we were too bearish. Here's a reason to be bullish. Most stocks are up. That's a bullish sign. So even though we talk bearish all the time because it's more intellectually interesting, most stocks are up. And stocks being up leads to more stocks being up. This is a bullish sign. And this is why I don't discount technical investing, because sometimes things like this have nothing to do with fundamentals, but it leads the market. People see this and they say, all right, stock's going up, we're putting more money in stocks. So I think it's just really important to kind of open your mind to the different ways that people look at the markets and how it impacts it. I'm going to mention one more thing, and then we're going to hand it back to Doug. Doug talked about the bullwhip effect a few minutes ago. Here's a bullwhip effect. Here's at the left. Here's 4 charts: wheat, corn, natural gas, and lumber. As you'll notice, 2020 things went down, and then they skyrocketed. Wheat skyrocketed into 21. Corn, same thing, skyrocketed into 22, 21, and then went down, then went back up in 22. Natural gas skyrocketed into 22. Lumber, 21, went down, went back up in 22. Lumber is a good example of the bullwhip effect. So is corn. But what you should notice is we had these spikes and things have come back down, which has boggled everyone. Everyone is confused as to why this is happening, because it's not normal. Anyone realize that Powell hasn't come and done his victory lap over the soft landing that he's been trying to get? It's because nobody's been able to predict what's going on in the markets. It's very hard to predict what's happening. And he's no different. No one's been able to predict that we haven't had a recession, that stocks will keep going up despite the fact that interest rates are high. Everything that's going on has not been predicted by virtually anybody, because it's different from the paradigm that was before. And we talked about this before. The paradigm shift happened a few years ago. It happened in 2020. January, like January 1st, whatever, like that's when things changed. It changed before that, but that's really when it started to change. The paradigm shift happened, and we're still trying to figure it out. So everything you thought you knew about the markets, just throw it in the trash bin. It's different. It's different now. And we don't really know exactly why this is happening. And because you don't know, does that mean that you should get upset at the market for being wrong? Nope. Does that mean that you should change what you're doing? Maybe, right? Depends what you're doing. What it really means is it means that you need to revisit your assumptions. You need to look at the assumptions you're making and look at them and say, hey, is this still correct? Hey, higher interest rates should lead to lower stock prices, but they're not. Maybe I need to relook at things. Why is this different? Now, anyone can come up with an explanation after the fact. There are really smart people out there who are really good at coming up with explanations after the fact. This is actually what economists do. So if you wonder what economists do all day, this is what they do. They look at history and say, oh, I have a thesis for this. It's great. It perfectly fits the thesis. We talked about curve fitting on an earlier episode today or yesterday. Curve fitting. It's basically looking at the data and saying, oh, I've got a thesis for this. Look, it marks it perfectly. Well, when you're looking at history, it's not hard to do that. But when you're looking at the future, it is very hard. And so when you look at things like this and say, why is this happening? We have higher inflation. Why are prices not higher? Makes you wonder. Well, there's a thesis we can come up with. I wouldn't say reasons, because we really don't know. No one knows, but you can come up with some thesis. One I will say is interesting, and then I'll give it back to Doug again, is I was listening to a podcast with someone, and they were talking about the concept of inflation. Now, we don't normally think of it this way, but the concept of inflation and deflation is really fascinating. So deflation is the kind of thing that basically prices of everything go down and your cash goes up in price. So like 2008, stock prices, asset prices went down 50%, your cash went up 100%. It actually didn't change, but everything else went down. So in proportion, it went up. So deflation, cash is king. In inflation, you want to get rid of your cash. You want to invest in hard assets, leveraged assets, debt, things like that. Productive debt. Let me be clear. Productive debt. So if you're looking at what's happening now, I would argue that for the most part, for the last 15 years plus years, we've had deflationary effects that have not shown up. They've shown up as low inflation. But now that we have higher inflation, things are different. And people are not catching up quite yet. People haven't caught up to the fact that things are different. So they're still acting like they are in the old paradigm, but they're confused as to why we're normal. So why are stock prices going up? My thesis is that at the moment, what are you going to invest in to keep up with inflation? Like, you could argue what inflation is. I always argue it's higher than what people think. Why are my food prices going up 100% in the last few years and they're only showing up as 8%? Go figure. So I don't think people believe it, and they're looking for ways to keep up with inflation. Stocks have done very well in the face of inflation. Gold is starting to pick up, even though it has not done particularly well. It is now. Cryptocurrencies have done well in the last year or so, or year and a half. So I wouldn't say it was all the time, but point being is people are looking for things to invest in that are going to keep up with inflation or surpass inflation. There's very few things out there that are doing that. And people are still chasing, what do they say, chasing the dragon. They're still chasing the high, the tech bubble high. At some point, that's going to crater and it's going to be ugly. But, some really, really smart people like Jeremy Grantham at GMO, who predicted the tech bubble bursting in 97. He predicted the housing crash in 2006. Great at predicting, just way early. So are there people predicting the next cycle? Yes, but hasn't happened yet. So as you're kind of looking at things, you don't have to know why. I think it's maybe due to consumer sentiment on inflation or whatever, but I actually really don't know. I don't have a great answer. But you know what? It doesn't matter. The why doesn't matter. You don't need to know why. You just need to know what. And what is the stock market is going up. So that's all you need to know at the moment. If you're confused about why, just stop trying to understand the markets. They are not understandable by anybody. You can say the behavior is predictable, but it's not necessarily understandable. So just keep that in mind. If you're trying to understand the market, that is going to be one of the biggest challenges you have as an investor, is getting over your own mental hurdles of trying to understand the market. You're never going to understand it. Come up with some themes, come up with some systems that are predictable, that work consistently. That's a better methodology than trying to understand the markets. You're never going to understand them. Why is this going up? I don't know. So don't ask. We've had people ask, why is this going up? I don't know. No one does. You're not going to know it. Just get over the fact that you're not going to know it and either invest in it or not, but use a system that works. Doug, what about you?
Well, yeah, and I got a question I want to throw back to you, but I'll in a second. But a couple of things. First of all, I just again, for humor and jest, I noticed on the chart you were looking at, Boeing is crashing. I did, while you were looking that, I did notice and look up Airbus, and Airbus is soaring. So I don't know. Take that as you leave. Airbus is soaring. Boeing is crashing. Yes, absolutely pun intended. The other thing I did confirm, Apple is looking at robotics. And it's interesting. They got it. They got out of the AI, the AI auto side of it. They're now trying to shift to the AI home side of it. That's where the robot idea comes in. And again, correlation, speculation, not sure. But notice that Tesla's had an incredibly challenging year as well. So I think from the aspect of automotive, it has definitely been, increasing struggle there. A couple other things I wanted to add in, which, one of the things we have, we've talked about before, U.S. debt Couple of notes. The U.S. national debt, since the net debt ceiling was suspended, this is from Creative Planning, Charlie Bilello, since 6/2 of 2023, because I know we're coming up against another, I think what we just did, they just did agree to raise the debt ceiling again and get us past another potential lockdown. It was at 31.4 trillion in U.S. national debt as of June of 2023. We are now looking at roughly 1 year, a little less than 1 year. So what about 8-9 months since then? And we are now at 34.5 trillion. We have gone up $3.1 trillion since they suspended the debt ceiling in June of 2023. Again, we've talked about this before. What is the impact of that? It depends. The federal government has a lot of flexibility to deal with their debt, with their GDP. But of course, when it comes to interest payments and higher interest, then that is certainly going to be a greater strain on the financial condition and kind of an exponential impact, because again, if they already have the debt, just like households, the interest rates go up, you spend more money on that interest, you don't have enough then again to cover everything else, you have a decreasing amount of money left available in order to cover the rest of your expenses, and that ends up creating more debt. So the spiral is certainly a concern. Well, what about cutting the interest rates? Again, we came into this conversation today talking about the cutting of interest rates that were predicted going into this year that obviously hasn't happened. But let's talk about, for a second, some of the impact of interest rates that have been cut in the past. Obviously, that was leading to this market bullishness. However, going back to, it looks like at least data leading back to 1974, I have a chart here that talks about the percentage change in S&P 500 and in days from the first Fed cut to the S&P market low. Okay. So the trading days on average, just to kind of not get into the weeds on this, the S&P 500 fell approximately 23.5% over a period of 195 days from the first Fed cut to the market low. Okay. So that's the average. Now, some of the days back in 1980, looks like there was a positive growth in the market, but 87, 2020, 1974, 1981, 2001, 2007, which was one of the worst, there was about a 55% decrease, 350 days from the S&P, from the Fed cut. 350 days later, the market was at a low. So, again, a lot of people think that when interest rates go up, when they raise interest rates, it's negative for the market. I don't know I think we've talked about this before, but there's definitely historically, when they've raised interest rates, it's actually had a fairly positive impact on the stock market over the long run. We may be seeing some of that now. The predictions, again, positively, those lowering of interest rates, be careful what you ask for, because there is a lot of data out there that has shown historically, after rate cuts, which are supposed to be market bullish, there's actually been it's been a leading indicator. Correlation, causation, again, separate things, but it's been a leading indicator of future stock market decline. Now, another thing too is looking at the ratio of the S&P 500 to the U.S., to the U.S. long-term Treasury, the TLT. This is specifically SPY ticker to TLT ticker. Ultimately, the ratio, so the last time that the ratio of the SPI to TLT was this high on a 9-month average was actually in 2006, leading, where obviously, or I'm sorry, it was 2007, which led into a fairly interesting 2008. This latest trend of the SPY to TLT has really started taking off around 2022 and led to this high that we're at today, which is kind of along sloping to where it was back in 2007. So there's some interesting things here when you start looking at those ratios. Again, doesn't necessarily mean something is imminent negatively coming along, but it does just kind of go into stating, yet there is risk there. It is also stating that if there is a prediction of or a hope that there's going to be rate cuts, that may not necessarily be as bullish of an outcome as people ultimately tend to believe. Now, I want to send this back to you, Kirk, with a quick question. Let's go back to this market, not knowing how long it's going to be. Like you said, I don't know. Would you sell right now and get out of the markets? And the answer to that was a very confident no, because you don't know what's going to happen with this market. What if you were one of the individuals that was sitting on the sideline during this? Let's say you got spooked last year, October, market's down, hit your threshold. I'm ready to get out. Market's gone on a tear since then, right? Really bad timing. What would you tell someone that's been sitting on the sideline that at one point, that now is thinking, what do I do? Like, I want to get back into the market. I'm watching this. It's getting harder and harder to sit on the sideline. I've really screwed up. What do I do now?
That's a great question, Doug. So ultimately, what it really comes down to is you need to have a plan. And everyone says this, and some most people don't even pay attention anymore, but you really need to have a plan. So if your plan is FOMO, oh my God, things are going up and I'm not on the train, I got to get in, that's a bad plan. Now, if your plan is I'm going to jump on the train, I missed it, I'm going to jump on it because it could keep going, right? You don't know. But you need to have a plan. So maybe your plan is, oh crap, I missed it, let me jump back in. And you say, all right, if the market goes down 5%, I'm out, right? Trailing stop, whatever it is, I'm out. So then the worst I could do is lose 5%. Okay, that's a plan, right? That's a plan. You need to come up with a plan. So, for example, if I'm looking at a handful of the investments that are going up, gold is broken out. That has done very well in the last week. It's gone up a lot. It's gone from like 2040. Now it's at 2345. That's a big hike. Today being one of them. I think today it's up like 8.5%, something like that, something crazy. Or maybe that was yesterday. I'm looking at the chart here. But anyway, the point is gold's up a lot. Silver looks like it's starting to break out, although it's hard to tell because silver's been sideways. You can look at certain stocks. Ultimately, if you're missing out, like crypto is a good example. Everyone's like, oh, I'm missing out. Like it's too high. Okay, that's too high. You can ignore it, or you can take a small piece. Here's another way. You don't have to go all in, right? We just talked about have a trailing stop. That's one way to jump in. Another way is start small. Put in one. Let's say you want a 5%. Let's say you're investing in the S&P 500 for the sake of example, and you want a 5% of your portfolio in the S&P 500. Start with 1%. See how that goes. Add another 1% and another one. Map it out, right? It's not all in, all out. This isn't this isn't Texas Hold'em poker where you're going to go all in. Choose the allocation you want. Try with a smaller amount. If you're going to put 5% in, maybe do it in 1% increments, or maybe you do 2 or 3 or 4. Like you split up any way you want. But the point is you need to come up with that plan for figuring out how you're going to get in so you don't miss out. Now, the reality is you should never be chasing these things anyway. You should have your things that you invest in and know those inside and out. So I know gold. I've been investing in gold for my whole career. I know it. I'm comfortable with it. I know it goes through cycles. I understand the cycles. Like for me, I'm comfortable with the operations of it. I'm also comfortable with the operations of Bitcoin because I've been following it since 2017. I'm comfortable with the big swings. I understand them. And I'm not picking tops or bottoms, but I don't have to because I'm hitting the meat. I'm hitting the fat pitch, and that's all I'm looking for. It's the fat pitch. So if you can find areas that are left for dead or beaten up, we talked about one on the show. I'll mention this one. Natural gas. Natural gas is in the toilet. I'm not sure if it's all-time lows, but I think it bounced off all-time lows earlier this week. Let me see if I can share that screen because I think it's instructive. Here we go. Here's natural gas. That's a price the last, I don't know, whatever, it's 5 years. Look at it. It's down here. It's close to the 5-year low. I don't know what it was prior to that, but the 5-year lows. I guess if you go back far enough, you see, oh, even then, it still hasn't gone as this low. So it's really low. So does it make sense to take a flyer on natural gas? Maybe. Don't know. It depends. You have to make that determination. Here's crude oil. Remember this? 2020 went negative. The futures actually went negative. I'm not going to say it's never going to get that low again, but the likelihood of that happening again is slim and none. So that was a great time to invest in oil stocks or MLPs or all the other things that we were doing back then. Like there's a lot of opportunities back then, not so much now, right? Natural gas, on the other hand, well, there's some opportunities. Maybe you should look around, right? Look around and see what are some good opportunities from investing in this. Here's another one. Coca, we talked about this. Wow, look at this. This looks like Nvidia or Bitcoin. No, it's Coca.
Are you trying to share?
Oh, I'm sorry.
Yep, no problem. Nobody's can see any of them.
I didn't see the last few. Sorry, I was sharing and no one was looking. So no one. Thanks for telling me, Doug. No one said anything. You guys got to message me earlier. Okay, so let me go back and share these last.
It was
few.
very interesting how excited you were, though. We were.
Yeah,
I think everybody was just getting into your emotions behind it.
So natural gas. I'm gonna go. I don't remember which one was showing. So here's natural gas. Here's like the whatever 25-year. It's as low as it's been. Right. That's a low price. You want to jump in there. Oil. That would have been a good price getting in here because that's not as low as it's ever been, but it's pretty darn low. Right. So you want to look for those opportunities. And here's the opposite opportunity. Let's look at Coca. Wow. Look at that. Like I said, Nvidia, crypto. Nope. It's Coca. That's
if you have cocoa in your pantry right now, you want to sell that.
Yeah, it's like remember when eggs went up to like $30 a dozen or some crazy amount, and people were going out and raising chickens as if eggs would stay that high forever. Like I was just laughing, like, "Oh, I'm gonna start a chicken farm." Like, good idea. By the time you get the chickens, it'll be back, which it was. But if you look at this, right, this has taken off mainly because I think it's like 90% of cocoa comes from one of the African countries, and they're having some issues over there, and so it's a global problem, which is why the prices are high. But I look at this and say, is this rational? Is this going to stay like this forever? Probably not. So what are the impacts of this? Well, here's an impact. High prices equals companies getting really rough earnings. Well, let's look at the confectionery companies. We didn't mention any names, and we won't, but there's one in particular I'm eyeing because, hey, it looks like an interesting opportunity. It's down a lot. These prices won't last forever. You know, some of the prices have been hedged. And when this comes back down, then, you know, things will be back to normal. But the point is look for these opportunities. They are out there, right? You look at the metals, you look at gold, here's the other one, gold popped up, silver's starting to, platinum, palladium are down because Russia's dumping their supply in the market. Copper's kind of, you know, it's kind of going sideways. Anyway, we're going to wrap it up here. I'm going to give Doug a final chance to chat, but this is a good market to look for opportunities. You don't always have to chase the hot dot. You can look for opportunities because things like natural gas, for instance, it's not going to stay down forever. Uranium has been in a bear market for a long time. It's not going to stay down there forever because it can't. Eventually, people have to buy it, which means that the price will go up. So all of these things are normal in a normal economy. Ups, downs are normal things. You want to buy them when they're low, sell them when they're high. That's how economics works. Go ahead, Doug. Wrap us up here. Final thoughts.
I think you made. Those are some really good tidbits. The one that I particularly like historically, and again, if you're not into individual sector purchasing, and you're more of a broad spectrum index kind of investor, but you've been extra cautious, extra bearish, and unfortunately missed a heck of a run. I think I've talked about this before, maybe on this or in one of the other conversations but I like, personally a mixed dollar cost average strategy, where, look, I don't know, this market could go for a run for the next year. Like you said, could go on for years. So, having an allocation of a certain degree of a chunk of your investment into the market is going to give you that access to that continued run. But what if it's wrong? What if it has peaked out, right? Well, it's still going to give you, if you keep a certain percentage of cash, and in this case, maybe it's a 50-50 thing. Maybe it's a 1/3 thing. It's like, I'm going to put something in. Now the rest of that cash, if it dives down tomorrow, and this kind of goes back to a Nick Murray thing, the day you make an investment, that market is going to go down. That's the mindset you have to have. Okay. And so let's say it does. Well, guess what? You didn't put everything into it. Yes, it was expensive. Yes, your timing is wrong. But like Warren Buffett, got cash to work with. I'm going to take that cash. I'm going to put it in. So what do you do with the rest of that cash? Because what if the market does run, or what if the market starts going down? That's where you could look at dollar cost averaging over a period of time, the rest of the cash, whether it's going to be over 6 months or 12 months or 18 months. You systematically get it in to where if you are right, you're going to continue to get improvement on the investments you've made. And if your timing is wrong, now you're going to have the flexibility still with a chunk of remaining cash to be able to make one of those strategic investment entry points or sales that allows you to be able to take advantage of that price shift. Okay. So I think that's a good way to look at it too. And I think and I, personally, back in 2007, used that to a great effectiveness. 2008 came along, and it was a wonderful way of being able to say, look, we've got some work to play with here, because now it's given us a sign. Now we've got this cash. Now we can make a significant purchase of something that has given us a much better value and entry point. So there's a couple of thoughts there. Listen, speaking of entry points, one entry point you're not going to be able to control is if you have kids and if they're going to go to college. And listen, college is expensive. The government just added $3 trillion in debt. They might be able to afford it, but it is not going to be easy for you, the average family, to afford $100 or $200 or $300,000 in debt. The last thing you can do to give yourself financial security and to have your financial house in order is to walk into college and at the last minute get told what the price tag is going to be, because you're not in control of the decision. Take control now. Doesn't matter if you have middle schoolers, doesn't matter if you have elementary schoolers, but especially if you have high schoolers and you have not started to look at the cost of college and how you're going to pay for it. How you pay is just as important as what you're going to pay. There's not only getting the cost down, but it's being more effective and more efficient with the money you have. Find out today. It could save you hundreds of thousands of dollars of your retirement if you do this right. That is worth a free conversation. Go to our website, ProCollegePlanners.com. Get some information. We got some free numbers. We got a free tool you can use, a free report. Just go take 5 minutes, download the free report, start there, and then you might just absolutely change your world and save yourself your retirement.
Great. Well, Doug, always appreciate you coming on the show. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.